Good morning, Peter Holtz, CPA, with another Write-Off Wednesday. Hey, we are seeing a lot of people this time of year who are trying to get their bookkeeping together, trying to get their business accounting together. And a really common theme that I'm seeing, and I talked to two people about this yesterday, is the fact that people aren't saving receipts. And, they're disorganized, there's a bag of stuff. Actually, there's three people yesterday. There's three we actually talked to about. It is really dangerous. For close to a century, okay, the IRS has a way of working with small business where they basically deny you expenses if you haven't got the receipts for things like travel, for things like office expenses. No receipts, no write-offs. That's how it works with the IRS, okay? And you got to save them. They have to be organized. You've got to be able to survive an audit with the IRS with that. And that's one of the reasons in our bookkeeping system, we've implemented virtual file cabinets to help you simply, quickly take a picture of that receipt with your phone. It gets automatically filed. It's ready to go. If we ever get an audit, we download stick drive to the Internal Revenue Service. They got everything right there, organized by vendor. The bookkeeping package works with a virtual file cabinet. I mean, it's really a phenomenal system that is very efficient for you and saves you tons of time. A lot of business owners have this plastic bag or shoebox full of receipts that they dread dealing with, and it sits there for months and months and months, like an annoying thing that you never take care of. So it's really critical. There is a famous story about there's a rule in the IRS called the Cohan rule, and it was done by it was done in relation to the position the IRS took with George M Cohan, who was, if you remember back in the 1920s and 1930s, this is what I'm talking about, 100 years, they denied all his travel expenses, and George M Cohan was a famous vaudeville performer, and it was obvious he had to go from town to town to town on trains. Well, like many other creative people, he never saved his receipts, and the IRS says, we're denying all your travel expenses. Well, he went to tax court. The tax court said, no, you have to give him travel expenses because that's a function of his business, and they had to settle on something because the IRS wasn't going to allow him zero. So, I mean, that's how far back this goes. That's how well established their procedure of no receipts, no write-offs is. When something like that is 100 years old, you're taking a tremendous risk as a business owner to not properly document your business. You must have a separate bank account. It's got to be reconciled. You've got to have a complete set of books, and you've got to have the backup. Otherwise, you're taking a risk that, if you're making over $60,000, your marginal tax rate is going to be 47%. Okay, on top of that, they're going to hit you with penalties and interest. You could easily pay 80%, okay, of your additional hit. If they find $20,000 in additional taxes, they could make you $20,000 in additional expenses that they get to write off. They could hit you for taxes and penalties and interest of 16 grand. Okay, and it could be very, very difficult to deal with, and very, very painful. So you got to document your stuff. Give us a call if you want help with that. We've got a really neat and effective system for it. And I'm just trying to share you on this Write-Off Wednesday additional information you need to know to help you be successful and safe from the IRS. Thanks, you guys have a great day.